forecast. The inflation forecast is really well anchored in the range of price stability, going slightly down. And we will see in June whether the situation is different, whether inflationary pressure continues to decline.
Live now to Emma Wall. She's head of investment analysis at Hargreaves Lansdown. She joins us live from London. Emma, the BOE held rates here, but inflation is falling. Why?
Well, I think what's really interesting here is if you look at the headline rate, it's obviously no change. And so if you don't dig into the data, you think, come on, guys, actually progress is being made. But actually, the key thing with yesterday's news for me was the voting data. And this is the first time in many months that you haven't actually seen a three schism across the voting. So last time around, we had members voting for a hike, members voting for a cut, and members voting to stay and hold. And this time around, it was the first time in some time that actually the votes were yes, the majority were hold, and one was cut. And you're losing those voting members. There have been one or two that have been, for the last 6 months or so, voting for more rate hikes. So although on the headline rate hasn't changed, the market reacted very positively because ultimately this is seen as a slight nudge towards yes, things are turning around, policy in aggregate hasn't changed, but the movement is towards cuts in the future. And that was very much the forward guidance that the Bank of England Governor Andrew Bailey gave, both in news that's out this morning under embargo and in the conference following the decision.
You're exactly right. And I think the composition of the decision-making on the board is changing. That's why markets reacted in the way they did. And also Governor Bailey really hinting at potential future rate cuts as well. So what economic conditions need to be satisfied here, need to be met before the BOE considers actually lowering rates?
It's very much inflation, both in terms of CPI and core CPI, but also in terms of jobs data, so wage inflation. You'll remember Mark Carney, when he was Bank of England governor, was actually very specific on the forward guidance he gave, and he said that unemployment had to be below 7%. And then unemployment fell below 7%, and he didn't then begin to change rates. And so I think the Bank of England now is mindful not to give too specific guidance, because then you get that moniker that Mark Carney earned himself, which is the unreliable boyfriend. But it's very much the language is about we want to see inflation come down further. You know, inflation is still 3.4%, which is down considerably from the October 2022 highs. But underneath that, you're still seeing quite a lot of inflation. Food in particular in the UK here is a problem, particularly chocolate, which as we go into Easter is concerning, I'm sure, for many households. Chocolate's running about 9% inflation. Olive oil's running about 40% inflation. So we want to see inflation come down, and we want to see jobs growth, which has been positive because actually people then have been, that cost of living squeeze has been easing for people, but we want that to steady because, of course, wage inflation feeds into those demand figures, which then feeds into the headline inflation rate. So it's all about inflation.
Yeah, indeed. And you know what? I forgot about that. I'm so glad you reminded me, Emma. That tag of the unreliable boyfriend still plays strong today. It's something that he hasn't really been able to shake off, is it? Okay, look, let's shift our focus over to the SMB. I thought this was a fascinating move as well, really perhaps front-running the Fed here with this surprise cut. So why now? Why not wait?
Absolutely. I think this really surprised the markets. I mean, look, central bankers don't have to do what the markets expect them to do, but broadly the expectation was the UK across Europe, so ECB and Swiss, and the Fed aren't going to make moves until the second half of the year. So to see the Swiss National Bank move ahead of that, ultimately, it's because confidence and data points are there that they feel they can make cuts, although they themselves said they do not expect this to be now several cuts in a row in rapid succession. It will probably be a cut and hold strategy for them and to bring themselves back in line with that consensus. For us, our house view is still very much yes, one national bank has gone. That doesn't necessarily mean that our expectations for the Fed move forward. We're still very much thinking this is about the second half of 2024. And then we expect actually the Fed and the ECB and the UK, the Bank of England, to move reasonably in step, actually. So it's cuts, but it's slow. It's not rapid succession. Markets are expecting 3 rate cuts from the Fed in the second half of the year. We're aligned to that.